As an investor on the JSE, it is important for you to understand exactly what companies are, how they came about, and the main laws which govern them. Those laws, first and foremost, are contained in the Companies Act, which is number 71 of 2008, and it came into effect on the 1st of May 2011. In this webinar, we're going to go through some aspects of that Companies Act which affect you mostly as an investor. But first, let us begin with a little background and history. Companies were developed because of the need to raise large amounts of capital. The technology developments which led to the Industrial Revolution made it possible to undertake massive investment projects, like building a railroad right across America. But such projects required enormous amounts of capital, which could not be raised by the existing types of organizations like partnerships, sole traders and guilds. So a new type of organization had to be developed in order to accommodate that need. And that was the joint stock company. Companies are different from other types of organization because they are legal persons. The law treats them exactly the same way as it does you or me. And this has a number of important implications. Let us consider the two main responsibilities which they have, which are that they are responsible for their own debts and they are responsible for their own management. In a partnership or sole trader, the partners or sole trader are responsible for their own business's debts to the fullest extent of their assets. This means that if the partnership goes bust, its creditors can come to the partner's house and take his personal assets. In fact, they can sell the house in order to recover their debts. The same is true of a sole trader. In other words, the law does not distinguish between the partners themselves and the partnership when it comes to debt. They are regarded as one and the same thing. But companies are separated from the people who own them, their shareholders. The creditors of a company cannot go to its shareholders because the shareholders' liability is limited to the amount that they paid for their shares. They cannot lose more than that, no matter what happens. If you think about it, this is very important. Imagine if just by buying 100 shares in Anglo-American, you immediately became personally responsible for all its debts. In other words, if Anglo went bust, the creditors could come and take your house and your assets and sell everything that you've got. Nobody would ever buy any shares if that was the case. So limited liability makes it possible and attractive for people to invest in shares. And nobody would buy shares if there was no limited liability. The second major characteristic of a company is that it has a separate management from its shareholders, usually, in most cases. I mean, there can be directors who own shares, but in most cases, the majority of the people who own the shares are not also involved in the management of the company. As a sole trader or a partnership, those people are usually directly involved in the management of their business. This is important because you can imagine the chaos that would exist if all Anglo-American's hundreds of thousands of shareholders were directly involved in its management. That would be nonsense. So this is another factor which makes it possible for companies to have thousands of shareholders who are not directly involved in the management but who nonetheless contribute capital. Let us sum up then. The two major things which separate a company from partnerships or sole traders and which make it possible for that company to raise capital are, first of all, that their shareholders have limited liability, and secondly, that the company is responsible for its own management and that shareholders or owners are not involved usually in that management. This has made it possible for companies to raise enormous quantities of cash. The owners of companies became shareholders, each buying and owning a small piece of the business, which gave them the right, in due course, to receive their share of whatever profits the company made, which we call a dividend. And of course, the fact that a company's owners were not also involved in its management and were not responsible for its debts meant that it was possible for them to buy and sell those part ownerships or shares amongst themselves in what we have come to know today as the secondary market. To refresh your memory, the primary market is where a company sells its shares to the public in order to raise the capital which it needs to establish or grow its business. And the secondary market occurs where members of the public buy and sell those shares between themselves. So with the development of companies came the development of share markets. The first share market took place in a popular cafe, where the people who owned shares used to meet and talk regularly. Naturally, they began to buy and sell their shares, and the waiters in the cafe acted as their agents. So a person wanting to sell his shares would simply tell the waiter how many shares he had and how much he wanted for them. And then the waiter would try and find somebody to buy them. If he was successful, he earned a small commission, which was called a brokerage. And that is what we know as brokerage today. It is interesting and amusing to think that stockbrokers were once waiters. But these new companies gave rise to a whole range of new problems. And these problems created the need for new laws, most of which were designed to protect the shareholders. Eventually, these laws were gathered together in the form of the Companies Act, a body of law which has been refined and improved countless times over the centuries into the law which we now have. The first problem which the Companies Act seeks to address is that all those shareholders who, remember, were not directly involved in the management of the company had to be kept informed about what it was doing and how it was performing. This gave rise to the need for proper disclosure of key information. Today, in terms of the Companies Act, companies must produce a document called a prospectus if they want to sell shares to the public in the primary market. This document contains details of the company's incorporators, that is, the people who started the company. It gives their names, their addresses, their qualifications, and their past experience. It must also disclose what the company's business is and give a good forecast of the future profits. In the prospectus, the directors must say how much capital they need to raise in order to make the business a going concern. That is known as the minimum subscription. And if they cannot collect that, if they fail to raise the minimum subscription, then they have to pay everyone back who applied for shares. Another key element of disclosure is the regular publication of the company's interim and final financial statements. Over the years, the financial statements have come to include 4 key elements: the income statement, the balance sheet, the statement of cash flows, and the statement of changes in equity. In addition to these, there should also be an auditor's report and a director's report. The chairman's statement, which is incorporated in many sets of financial statements, is actually not a requirement of the Companies Act. Exactly what is contained in these financial statements is set out in great detail in a substantial document called Generally Accepted Accounting Practice, or GAAP. And accountants spent a lot of time studying this document so that they can prepare a company's financial statements correctly. The financials have to be produced twice a year. After the first 6 months, that 6-month period is reported on in the interim financial statements. And then finally, the progress for the whole year is reported at the end of the financial year. These financial statements are there to provide shareholders with the information they need to make a decision on whether to invest in the company or not. These days, the company's latest financial statements are normally posted on its websites in the form of a PDF file. You can easily go onto the website and download that PDF file so that you can study the financial statements at your leisure. And indeed, you should do that. You should get hold of all the financial statements of the companies that interest you and read through them carefully. At first, you may not understand everything that you read, But as you read more of them, and as you study the lecture modules, you will gradually improve your understanding of financial statements. Remember, Warren Buffett, who is arguably the most successful investor who has ever lived, studies around 2,000 sets of financial statements every year. Companies, and especially those listed on the JSE, have to disclose many other pieces of information. At their registered office, they have to keep a register of fixed assets. They have to keep a register of directors. They have to keep a register of directors' interests in the company, and so on. Those companies which are listed on the JSE have to follow the JSE rules, which require that all listed companies must make regular announcements on the Stock Exchange News Service, or the SENS, as it is known. Shortened forms of the company's financials are posted on the SENS as soon as they become available. Any corporate action, like the payment of a dividend or an impending rights issue and the terms of that rights issue, must be announced on the SENS. Any purchase or sale of the company's shares by its directors must also be posted on the SENS, as must any significant change in the company's shareholding and its major shareholders. Share buybacks, share splits, consolidations, cautionary announcements, mergers, takeovers, acquisitions, and many other important events must be disclosed on the Stock Exchange News Service, so that all shareholders are immediately informed and can take whatever action they deem to be necessary. So it's important for you to get access to the Stock Exchange News Service and to follow it closely, because it is a very important source of information.